Welcome to The Explainer. So, today we're digging into a pretty big economic mystery. Why does it seem like the United States economy is firing on all cylinders while Europe's is, well, kind of stuck in a lower gear? This is a growing divide with huge consequences for all of us, so let's break down the clues. And look, this isn't just a feeling people have. As our source material points out, a significant economic chasm has been opening up for the last 20 years. And this trend, it affects everything from who creates the next big tech company to who holds influence on the world stage. So, let's follow the clues together and figure out what's really driving this thing. And this slide right here, it really paints a picture of that gap. On one side, you have the United States, which is described as having remarkable dynamism and high growth. And on the other, you've got the UK and the Eurozone, which are struggling with lower productivity. So where do we even begin to unravel this? All right, let's dive right in with our first clue. And it's a big one, the money. We're talking about the financial engine that really powers economic growth. And as you're about to see, the American and European systems are just built completely differently. So the heart of the problem, it comes down to this massive gap in something called risk capital. Now, this isn't just any old money. You can think of it as the high-octane investment fuel that brand new companies need to grow into global giants. And how this capital gets raised and spent is just fundamentally different on each side of the Atlantic. Okay, let's zoom in on the venture capital world for a second. In the US, the funds are absolutely enormous. They're designed to write these huge checks for companies that are already on their way up. But in Europe, the funds tend to be smaller, more fragmented. They're great for getting an idea off the ground, sure, but not so great for turning that idea into a global powerhouse. This creates what's called a scale-up gap, where promising European companies just hit a wall when they need that next big injection of cash. But it's not just about the size of the checks being written. It's about the entire mindset, the whole culture of investment. The American approach is famously to shoot for the moon, this idea that you have to take massive risks to get massive rewards. In contrast, the European investment scene is often, a lot more cautious, more risk-averse. And this right here? This just nails the difference in strategy. US venture capitalists work on the home run principle. Just one massive success, a Google, an Amazon, can pay for 9 other investments that completely fail. European investors, on the other hand, often prefer the safer bet, something that's going to bring a smaller, more predictable return. It's a system that's just not as comfortable with the huge flameouts that often come right before a huge success. And here's the crucial result of all this. The financial gravity ends up pulling even Europe's biggest success stories over to America. When a really successful European company is ready to go public with an IPO, the US stock market just offers more money and much higher valuations. I mean, just think of Spotify, a classic European innovation that ended up listing on the New York Stock Exchange. Why? To tap into that much deeper pool of capital. Okay, so moving on to our second clue, you start to see that this whole thing goes way deeper than just where the investment money is. The very foundations, the playing field itself, are totally different. This is what we're calling the structural divide. Okay, here's a huge, really tangible problem for Europe, the cost of energy. Thanks to its boom in domestic natural gas, industrial energy in the US is just way, way cheaper. And this gives American manufacturers a major cost advantage before they've even made a single product. It's a gap that's only gotten wider because of recent geopolitical events. Now, you might be thinking, wait, doesn't Europe's single market fix all this? Well, it's not quite that simple. While it's fantastic for getting rid of tariffs on goods, the market is still surprisingly fragmented in really important areas, like services, finance, and especially digital rules. Just try to put yourself in the shoes of a startup, right? In the US, you're mostly dealing with one main set of federal rules. But if you want to scale your company across Europe, say from France to Germany to Spain, you have to navigate this incredibly complex maze of different labor laws, different tax systems, and different consumer rules. All that complexity just acts as a massive brake on growth. And that leads us perfectly into our third clue, the actual rules of the game. Let's take a look at how these really different philosophies on things like labor and regulation create 2 completely different environments for businesses to grow in. So European labor laws are pretty famous for offering strong protections for workers. And while that has some clear social benefits, it also makes the labor market more rigid. In the US, you have more flexible laws that allow for what economists call creative destruction. Basically, it's just easier for companies to pivot and for workers to move from older industries to new, more innovative ones. It creates a much more dynamic, fluid environment. Okay, to really get the tech side of this puzzle, you have to understand this one key idea, the precautionary principle. This is the philosophy that really drives regulation in Europe. And simply put, it means you prioritize safety and you try to prevent any potential harm before a new technology is even released to the public. So how does this actually play out in the real world? Well, the US generally takes a more laissez-faire or hands-off approach. Let companies innovate and grow first and then step in with regulations if problems pop up. Europe does the exact opposite with heavy upfront rules like GDPR. And while these rules are great for protecting consumers, they can create a kind of chilling effect on innovation, getting startups bogged down in compliance while their American competitors are just focused on growing as fast as they can. All right, for our final clue, we're going to zoom out from domestic policy and look at the global stage. Because we have to talk about geopolitics and the unique, almost unfair power of the US dollar. And this brings us to a really fascinating term, exorbitant privilege. It's what people call the incredible economic advantages the US gets simply because the dollar is the world's default currency. It's what everyone uses for trade, for finance, for savings. No other currency, not even the euro, is even in the same league. So what does that privilege actually look like? Well, think about it. When any kind of global crisis hits, a pandemic, a war, a financial panic, where does all the world's money go? It floods into US dollar assets for safety. This acts like a giant automatic shock absorber for the US economy, a luxury that no other country really has. And finally, you can't ignore simple geography. It really matters. The US is protected by two massive oceans. Europe, on the other hand, is right next door to instability on its borders. The war in Ukraine, for example, sent a massive energy-priced shock through Europe that the US was almost completely insulated from. That kind of geopolitical risk really puts a damper on investment and economic confidence. So, we've laid out all the clues, the money, the structures, the rules, the global power plays. What's the final verdict in our little investigation? The big takeaway here is that there's no single smoking gun. It's not just one thing. Instead, it's a combination of four really powerful, interconnected forces all working together. You've got America's deep, risk-loving financial markets. You've got Europe's structural problems like high energy costs. You've got totally different approaches to regulation. And finally, you've got the unique geopolitical power of the US. All of these together create this powerful cycle that just keeps reinforcing America's economic momentum. And that leaves us with one last really big question to chew on. For decades, the US and Europe were basically seen as economic equals. But as this gap keeps getting wider, what does that mean for the future of the transatlantic alliance? What does it mean for the global economic order? Definitely something to think about.